You ever see a stock rip 70% in a few months and think, did I miss it? Everyone's chasing the same headlines right now. AI infrastructure, liquid cooling, data center expansion, and in the middle of it all, super microcomputer, ticker symbol SMCI. I've been watching this from Thailand, and on Wednesday, I'm flying to the US to visit family, but this one couldn't wait. It's one of the hottest stocks on the market, and everybody's acting like it's the second coming of NVIDIA. But here's the truth. When a stock moves like this, it creates a problem most people don't recognize. The price tells one story, the fundamentals tell another. And in between those two stories is where people either make a fortune or lose their shirt. Now, I don't care about narratives. I care about execution. I care about cash flow, margins, customer concentration, and real competitive edges. So in this video, we're going to break down exactly what happened inside SMCI's latest earnings report. We'll look at where the growth is really coming from, what changed behind the scenes, and why most investors are asking the wrong questions about this stock. Because when the chart looks this good, the risks get easier to ignore. And that's when smart investors get hurt. Super microcomputers is up 72% year to date. In the last 3 months alone, it surged over 60%. Every AI-themed fund, Reddit board, and talking head is throwing this ticker around like it's the next NVIDIA. And on the surface, it makes sense. This company builds servers optimized for AI workloads. They're shipping systems that run on H100s and now H200s. Liquid cooling, they've got it. Fast turnaround, that's their pitch. And with data center spending projected to explode, this stock is sitting at the heart of the infrastructure. But here's the problem. Hype happens fast. Fundamentals don't. And when we open the actual earnings report, the one released on May 6th, the numbers tell a story that nobody's talking about. Revenue dropped from $5.68 billion to $4.6 billion in just one quarter. That's a 19% decline. Net income collapsed from $321 million to $109 million. That's a 66% drop. Gross margin fell to just 9.6%, the lowest in over 2 years. Those are not the numbers of a company riding an unstoppable AI wave. Management blamed delays in customer platform decisions and tariff impacts. But let's be honest, this was the first time in the last year where momentum broke. And when you're trading at a price to earnings ratio of 26.8, any slowdown gets magnified fast. So yes, the stock is up, but it's not because of what happened last quarter. It's because of what people hope happens next quarter. That's the difference between momentum and compounding. Momentum attracts attention. Compounding builds wealth. And here's the punchline. Momentum can mask a slowdown, but eventually the numbers catch up. So everyone's talking about SMCI's revenue, but revenue is just the top line. It's vanity. The real damage is under the surface, in the margins. Last quarter, SMCI's gross margin fell to 9.6%. That's down from 11.8% the quarter before and 15.5% a year ago. That's a 38% drop in margin percentage in just 12 months. In the server business, that's not a red flag. That's a 4-alarm fire. Adjusted EBITDA margin, the number that shows real operating strength, dropped from 10% to 5.6%. They lost almost half their profitability in just one quarter. And this isn't a seasonal dip, this is a structural trend. Why is that happening? Simple. SMCI is in a knife fight. They're competing against Dell, HPE, Lenovo, and other enterprise players who are flooding the market with similar hardware, often at scale, with deeper channel relationships. Liquid cooling was supposed to be their edge, but now it's a checklist item. Everyone's got it, which means SMCI's pricing power just got nuked. The only way to win that kind of war is to be the cheapest or the most differentiated. Right now, SMCI is stuck in the middle. Not the lowest cost, not the most defensible brand, and not vertically integrated like NVIDIA or AMD. And when you're selling commodity servers during an AI boom, margin erosion is not a risk, it's a guarantee. So while investors are staring at top-line growth forecasts, the story is here. SMCI is doing more business, but making less money per unit. That's not leverage, that's deterioration. The takeaway, revenue can grow and margins can shrink, and if you're not watching both, you're trading blind. Everybody thinks SMCI is an AI stock, and technically that's true, but here's what no one tells you. There are two kinds of AI companies. You've got the gold miners, the ones building the models, owning the data, developing the chips. That's NVIDIA, that's Palantir, that's OpenAI, and Anthropic. Then you've got the guys selling the shovels. That's SMCI. They don't make chips, they don't write algorithms, they assemble servers, they move hardware. And while that's important, it's not irreplaceable. In fact, it's becoming more replaceable by the day. Liquid cooling used to be SMCI's big edge. Their systems could reduce power usage by up to 40% compared to traditional setups. That mattered. But now, Dell, HPE, Lenovo, they all offer liquid cooling. It's not a moat anymore, it's just a feature. And that's the trap. SMCI is riding the AI wave, but they're not steering the boat. If NVIDIA changes its OEM preferences, or if a hyperscaler builds in-house, SMCI gets cut. No warning, no loyalty. That's the risk when you're a middleman. And even if demand stays high, SMCI is in a low-margin, high capital expenditure business with intense competition. They've raised debt, they've diluted shareholders, and they're now guiding revenue down for the year, even as AI demand supposedly explodes. So yes, AI is real, the tailwinds are strong, but SMCI's position in that supply chain is fragile, not foundational. The takeaway? Just because you're in the right market doesn't mean you're in the right position. SMCI is selling infrastructure. That doesn't mean they own the future. Let's look at the cash because this is where most investors get blindsided. SMCI pulled in $627 million in operating cash flow last quarter. Sounds impressive, right? Until you look closer, because behind the scenes, this company is propping up growth with debt and dilution. Long-term debt? Up huge. Convertible notes jumped from $1.7 billion to $2.4 billion in less than a year. That's a 40% spike. And it's not just borrowed money, they're diluting too. The float has exploded by 85 million shares in recent years. That means every dollar of future profit gets split more ways. Now here's the part no one's talking about. Over the last 12 months, SMCI's free cash flow margin was 0.1%. You heard that right. For every $1,000 in revenue, they kept just $1. That's not high performance. That's skating on glass. That means they're barely keeping what they earn. And when a company with razor-thin margins is also racking up debt and issuing more stock, that's not growth, that's a pressure cooker. And here comes the dagger. After all that leverage, after all that dilution, they lowered full-year guidance. They were calling for $23.5 to $25 billion in revenue. Now it's down to $21.8 to $22.6 billion. That's not a soft quarter, that's billions evaporated. If the business was humming, that number wouldn't move. So ask yourself this, if AI is the biggest opportunity in a generation, why does the supposed infrastructure winner have no profit, no cushion, and no margin of safety? The takeaway, this company is running full speed on fumes, and when the hype slows down, reality hits hard. Let's cut the noise and get to the only question that matters. Would I want to own this business for the next 5 to 10 years? Because short-term trades are one thing, but long-term conviction, that requires durability, margins, moat, and real leverage. So let's break it down. The bull case. SMCI sits at the center of the AI infrastructure build-out. They move fast, they customize hardware, they're one of the few who can deliver high-density GPU racks on short timelines. Their relationship with NVIDIA, AMD, and major hyperscalers give them exposure to explosive growth. They've scaled revenue from under $4 billion to over $16 billion in just 2 years. That's not luck, that's execution. And now the bear case. They don't own the chips, they don't own the data, they don't own the software, they're a middleman. Their gross margin is down to 9.6%. Free cash flow margin is miserable, 0.1%. That's barely staying afloat. Liquid cooling, once their edge, is now a commodity. Dell, HPE, Lenovo, everyone's in the game. They're issuing debt, they're diluting shares, and they just cut full-year guidance in the middle of an AI boom. So what's the truth? SMCI is a high-revenue, low-margin assembler playing in a red-hot space, but the business model is thin, fragile, and dependent on a supply chain they don't control. They're not building the future, they're shipping the boxes that power it, and those boxes are getting easier to copy and harder to profit from. The bottom line, if you're looking for a long-term compounder, this isn't it. The growth is real, but the edge and moat are gone. Let me break it down. Is this business getting stronger every quarter? No. Are the numbers trending up across customers, contracts, revenue, and cash flow? Not anymore. Is the product becoming harder to compete with? Absolutely not. It's actually becoming easier. That's all I need to know. SMCI is up over 60% in the last 3 months and almost 72% year to date. The chart looks incredible. The hype is peaking, but when I open the financials, I don't see strength. I see a company operating at the edge of risk. Margins are falling. Free cash flow is non-existent. They're raising debt and diluting shareholders while growth guidance is going in reverse. That's not a setup I bet on. That's a setup I avoid. Now, am I bullish on AI? Yes. Am I bullish on infrastructure? Yes. But here's the key. I only want to own the players with pricing power, with control, with real edge. That's NVIDIA. That's TSMC. That's Palantir. That's where the leverage is. That's where I'm putting my capital. So even though SMCI is getting pumped across every headline, for me, this is a hard pass. Not because it's a bad company, but because it doesn't meet the standard. The takeaway, when the market rewards hype, most people stop asking questions. But the people who win long term, they follow fundamentals. And by that standard, SMCI doesn't make the cut. Now let me ask you something. Who else breaks down stocks like this? Who gives you the bull and the bear case, builds the thesis, and shows you how to execute on it with real numbers? Nobody that I know of. That's why my stock accounts are up over 50% this year. That's why I made over $1 million last year and why I'm already past $1.7 million in 2025. And it's still July. This isn't theory. This is execution. And it's not just me. Tina made $2,289 on Friday. She's not a trader. She's not a hedge fund manager. She's just someone who finally decided to stop watching and start acting. This is SMCI's chart. It looks unstoppable, but the deeper I dug, the worse it got. This is exactly how retail investors get trapped, because when you only look at momentum, you miss the cracks underneath. My job is to find the cracks before your money falls through them. Inside my Patreon, you get real-time trade alerts, actual setups with entries, exits, and reasons, daily market breakdowns, the plays that matter, simplified, my full option strategy designed to be safer, smarter, and built for long-term investors. And it's less than $30 a month. That's less than most people spend on coffee, Uber Eats, or one DoorDash order, and none of those make you money. Try it for 1 month. If it doesn't help you grow, compound, and make smarter investments, then cancel anytime. No pitch, no pressure. But if you've been watching this channel nodding your head and telling yourself I should join, then it's time. Invest in yourself. Stop sitting on the fence while others build portfolios. Stop watching smart moves and start making them. Because the truth is simple. You can guess or you can execute. But either way, don't say you weren't told.